Okay, and let's go ahead and let's take a look at chapter 13. Okay, now you're probably looking at this and saying, hey, the name of this class is governmental and not-for-profit, and now we're going to cover not-for-profit essentially in 2, 3 classes. What's going on? Well, it turns out that I can teach you not-for-profit fairly quickly, in that we're just going to be focusing on a couple of standards that are issued by the Financial Accounting Standards Board. So instead of having to cover the entire gamut of standards for state and local governments that we have to do for the GASB, for FASB, we're just looking at a couple of their standards as relates to not-for-profit. So what we're going to see is that not-for-profit organizations use full accrual accounting, which you're very familiar with, right? We account for the organization as a whole. So we're not going to sit here and chop it up into funds and have to deal with reconciling funds to government-wide statements and all that fun stuff. So we're going to be able to sit here and use full accrual accounting, use it for an organization-wide accounting. Okay, so you listen to that and you say, well, then why do we even need a special lecture on not-for-profit? Can't we just apply what we know about about full accrual accounting to that? Well, there's 3 areas that I like to point out that are unique about not-for-profit that we're going to have to understand here. One is, what is the presentation of their financial information? Turns out that not-for-profits have a special presentation of their financial reports that we're going to have to understand that structure, so we're able to look at those statements and understand what they're trying to tell us about the operations of that not-for-profit organization. The second area that we're going to be focusing on is, how do not-for-profits account for their revenue? Okay, what happens? In a for-profit entity, the entity earns their revenues by providing services, etc., right? And a not-for-profit can do that. There's not-for-profits that provide services. For example, the AICPA is a not-for-profit organization that provides services, and we will be doing what? We'll be joining that after we get our CPA, whatever. We pay our dues, and we get a service from them. So not-for-profits do that. But much of what not-for-profits get in terms of a revenue, it's more what? A contribution revenue. People give money to the not-for-profit just because they believe in their cause. So we're going to have to understand, from a standpoint of contribution, when should a not-for-profit recognize a contribution that it receives? And we're going to see that a lot of that has to do with the form of the contribution is going to be how we're going to determine whether or not we should take the revenue for that. That's sort of the second area, maybe 2A. 2B is expense recognition, and that what? There are certain things that we're going to see when should a not-for-profit recognize an expense. For example, if somebody works for the not-for-profit for free, donates services to the not-for-profit, should we recognize that as an expense? And we're going to learn that under certain circumstances we should. So that's sort of 2 areas. The third area is a special issues related to not-for-profits. For example, how do not-for-profits account for their investments? They have rules that are different than commercial entities. How do not-for-profits account for a split interest agreement? What's a split interest agreement? I donate money to a not-for-profit and I say, hey, you need to take care of me in my old age, and then you hang on to this $1 million, whatever, right? So they're going to have to account for that a certain way, where what? They have that $1 million, but they're also responsible for caring for me in my old age, and then any money that's left over, the not-for-profit can use for their purposes. That's a split interest agreement. We're going to have to know how to account for that. We're also going to have to understand how not-for-profits account for a situation where they have a fundraising foundation that essentially funnels money to the not-for-profit. That relationship has specific requirements, accounting requirements around it. Okay, so we're going to have to understand something about those areas. I kind of put that in a special area. I'm thinking that we'll get up to about the revenue recognition, expense recognition part, the first 2 areas that we're going to study today. We'll probably get into that specialized area in chapter 13 next time, and then we will do the chapter 15, 16, looking at some things that are unique about educational institutions, and then healthcare organizations like hospitals. Okay? All right, so that's just where we're going now for the remainder of the course. So let's just go ahead and take a look and remind ourselves of a few things that are different from not-for-profits from governmental entities. Obviously, government not-for-profit entities are not part of the government, right? They're not-for-profit. However, some not-for-profits are owned by and operated by the government. That is not going to be the subject of what we're going to talk about today. Okay? But can you think of a sort of not-for-profit organization that is owned and run by the government? No. Planned Parenthood's on the short list of not-for-profits to not be getting much more money from the government. The San Francisco State is an example of a not-for-profit type entity that is owned and run by the government, right? Okay, so that's an example right there. Now, can you have a college that is not owned and operated by the government? Can you think of one? Stanford is the one that I tend to think of in this area. Who? Golden Gate is another one that I think I used to teach there. Golden Gate is a what? Is a private not-for-profit, right? What we're going to be studying is the accounting for private not-for-profit organizations who get their standards set by the FASB. If you're saying, well, what about the government not-for-profits, John? Well, we've really already studied that because what GASB says to those entities is they say, see what the state and local governments do? We pretty much want you to do that same thing. And so we've all, in a way, already studied that. There's a couple of unique aspects, but we're not going to get into that in this discussion. So we're talking about private, not-for-profit organizations that are formed by citizens that have a like cause that they want to support, and so they form a not-for-profit organization, and they seek donations for that purpose, okay? And that's what we're going to be looking at here in this chapter. Okay, now we take a look, and there are different categories of not-for-profits. You can have healthcare organizations such as hospitals, nursing homes, educational institutions such as colleges, universities. We talked about, for example, Golden Gate University, Stanford, obviously, big not-for-profit organization there, right? Okay. We come over, and there is sort of a catch-all category. They call these voluntary health and welfare organizations. So what happens? United Way is a classic example of a voluntary health and welfare organization. March of Dimes, Red Cross, Planned Parenthood, somebody mentioned, is an example of a what? Voluntary health and welfare organization. So it's sort of a what? Catch-all category for a vast number. Most of the not-for-profits fall under this category. Okay. I guess meaning that I don't know why it says voluntary. I don't know. I guess meaning I have no idea why they called it voluntary. Okay. I don't know. I guess meaning maybe you can volunteer to help there. I have no idea. Okay. All right. So let's take a look. And when we deal with the voluntary health and welfare organizations, we have what? Contributions coming from what? From these people. These are nice people that are sitting here and going to contribute money to the not-for-profit, right? When they do this, they do it in a non-exchange fashion, meaning what? They give the money, and they just want to see the not-for-profit go out and do good work that is consistent with their mission, right? They're not sitting there saying, well, I gave you money, now I want this from you, right? Okay, so they are non-exchange organizations. Now, that does not mean that they cannot have exchange transactions. I've already described membership type not-for-profits. You pay the dues, you get the membership, right? So they are not entities that you never have exchange transactions, but the bulk of their support comes from contributions, okay? So no one is sitting there expecting a return on their investment, so we don't really worry about a net income and maximizing income. We are sitting there and not having stock ownership, that sort of thing, right? Okay. Now, when we look at the requirements for not-for-profit organizations, again, we are following the requirements of the Financial Accounting Standards Board, of the FASB. Okay, remember FASB sets accounting standards for private entities. You've known that for a long time for profit entities and for not-for-profit private organizations. It's the FASB standards that we'll be studying here. And since it's FASB, that means that the standards that we're going to be looking at will be covered under the Accounting Standards Codification. The FASB has gone through and they have codified their standards by topic area, right? Okay. So have you studied this already? Accounting Standards Codification, any of the other classes? 302. Duke. Okay. Anyone else? Okay. All right. So the Accounting Standards Codification, they organize it by topic. Okay. So they'll have a topic, and then they will have a subtopic. We're going to see that one particular subtopic covers most of the information for most areas. Then we're going to have a section, and then detail is usually contained in a paragraph. Right, Lincoln? Does this sound familiar? Okay. So, for example, if you want to know something about statement of cash flows, you need to go to topic area 230. Everything you want to know about statement of cash flows is in topic area 230. Okay? Then what? If you want to know most of the things that deal with the statement of cash flows, you will typically go to subtopic 10. Subtopic 10 is overall. That's where we have most of the information about what you need to know about a statement of cash flows. If you want to know a presentation issue, for example, if I make an investment in property, plant, and equipment for my company, where should that be included on the statement of cash flows? There's three categories: operating, investing, and financing. If I make an investment in property, plant, and equipment, what part of the statement of cash flow should that be in? The investing section. And I would learn that in section 45 of the topic 230 subtopic 10 section 45 of the codification, because that's where they talk about presentation and disclosure issues, right? And of course I'm in the statement of cash flows area. And then paragraph would simply sit there and tell you whatever the specifics are that you're looking at. Property, plant, and equipment, and that's where they're going to give you the detail, right? Okay. Now, let me ask you this. I'm not going to ask you, I'm going to tell you this. If we are dealing with a specific industry, like the oil and gas industry, like the not-for-profit industry, what they do is they will put I always want to put 925 there. 958, John, not 925. 958 is the industry-specific area where they talk about not-for-profit. And then what they do is they start the codification all over again. You want to know something about the statement of cash flows for not-for-profit? Start with 958 and then go to what? 230. Most of the information will be in the overall subtopic. If you want to know something about presentation and disclosure, you go to 45, and then whatever the specifics are that you're trying to find will be in whatever the specific paragraph information is. So the codification still works the same for not-for-profits. We simply need to realize that we need to look into what? 958 is the area of the codification where everything about not-for-profits is contained. And then if you want to know something about the statement of cash flow, you'd go to 230. Something about the balance sheet, you'd go to 210 or whatever it is. And you would just go ahead and look through that part of the codification. So it's almost like an area code, isn't it? Okay. So the area code for not-for-profit is 958, right? Okay. Now you come over and you look at this slide here, and this slide lists the financial statements that are to be prepared by not-for-profit organizations. And you can see that you have the statement of financial position. Statement of financial position is like the balance sheet for these not-for-profit, but we call it statement of financial position. Now, in the codification, we know we need to be in Area 958, and since in the overall, for all entities that fall under FASB's jurisdiction, information about the balance sheet is in Section 210, so if you want to know about what? The statement of financial position for a not-for-profit, you're going to go to 958, so you're in the not-for-profit area, and then 210 for the balance sheet, right? For the income statement, we call that the statement of activities. And notice it has the same name as our government-wide income statement, doesn't it? Okay, so for the statement of activities, that is like our income statement. And of course, we need to be in 958 in the codification. And then for all entities under FASB's jurisdiction, you would look to 225 for information about the presentation of the income statement. Okay, I've already mentioned statement of cash flows is what? Overall, for all entities, 230. Since we're dealing with a not-for-profit, we can look up specific non-for-profit information about the statement of cash flows in 958. And the statement of cash flows is like the statement of cash flows, right? It even has the same name as the commercial statement of cash flows. Now, this last one down here is something called a statement of functional expenses. Statement of functional expenses is probably something you have not had exposure to because it's not something that commercial entities prepare at all. So it's a new statement that we're going to learn something about. I am not going to, require you to prepare a statement of functional expenses. I am, however, going to require that you understand how to use one and how to look at one, right? And so it's pretty easy, though. We'll go through that, even though you haven't probably seen that before. It's not that bad. Now, important takeaway from this slide. FASB only requires the voluntary health and welfare organizations like United Way, like March of Dimes, whatever, some of those that we listed, to prepare this fourth statement. All not-for-profits have to prepare the first three. This balance sheet, which we call a statement of financial position, statement of activities, statement of cash flows. All not-for-profits have to provide that. The healthcare organizations, the educational institutions, and the voluntary health and welfare organization. For this last statement, although they encourage the colleges and the hospitals to prepare it, they do not have to. Only the voluntary health and welfare organizations are required to prepare this statement of functional expenses. Okay? And that statement of functional expenses is covered in 958. 205, and I think I'm telling you to see these areas down here because that's where they call out that the voluntary health and welfare organizations are required to provide it. The others are simply what? Encouraged, and that's a specific area in the codification where they do that. By the way, I'm not going to hold you accountable to doing research or anything like that in the codification. I just want you to be aware of how not-for-profits are covered in the codification, right? If you took the CPA exam, you do have to do research in the codification on the CPA exam. They have task-based simulation, and there is one task-based simulation that is always dedicated on the financial portion of the exam to doing research inside of the accounting standards codification. So you do need to know how that works, but we're not going to get into that in this discussion. We'll let, is it Joe? What's her first name? Joanna cover that. Joanne cover that in 302. Okay. Okay. Good. So we come over and we take a look, and let me catch up my writing on here to the slide here, and we have what? We have our statement of financial position, which is like the balance sheet, right? So we're talking about the balance sheet, statement of financial position, and we have our what? Our assets. We have our liabilities. Assets equal liabilities plus, and instead of calling it owner's equity or stockholder's equity, we call it net assets. So assets equal liabilities plus net assets. So net assets is sort of like the equity of the not-for-profit, isn't it? But we call it net assets. Now, not-for-profits do not have stock, so there is no common stock, there is no additional paid-in capital. So that means that my net assets is essentially like my retained earnings, isn't it? So net assets is like retained earnings. So assets equal liabilities plus net assets. That's like the equity, but it really comes down to what? We've stripped that down to being like the retained earnings portion of our equity. Now, what do? we take those net assets and we break them into 3 categories that will indicate the level of constraint restriction that there is on our net assets. Just like in government, we had what? We had fund balance, and we had the 5 categories of constraint. We had at the government-wide level the 3 categories of constraint: restricted, unrestricted, invested in capital assets, net of related debt. Okay, so we've got what? We've got 3 categories here for not-for-profits. First category here being unrestricted. Unrestricted means that it is free of donor-imposed restrictions. If we put something in the unrestricted category, we are saying that the donor has not restricted our use of that resource at all. We can use it however the not-for-profit sees fit. Now, sometimes people imagine so they can go to Vegas with the money. No, they are going to have to use it in the what? Within the mission of the not-for-profit, but anywhere within that not-for-profit's charter, they can use that money. It's unrestricted. Okay, so only donors can restrict a contribution. Only a donor can restrict that. It's only parties outside of the entity, donors, that are able to restrict and say how those funds are to be used. Okay, now if the donor specifies that those funds are to be used in some purpose, they would in some operation of the not-for-profit, then those would be considered either temporary restricted or permanently restricted, which you see are the other 2 categories of our net assets. Okay? Temporary restricted means that the not-for-profit can satisfy that restriction either by some action or the passage of time. Okay? So let's talk about some action. You give me money, you give the not-for-profit money, and you say, please use this money in the research of a cure for cancer or something like that. So what happens? That's a purpose restriction. When you give them that money, you're telling them it is restricted. It must be used for what? Research of cancer, right? So it is temporarily restricted because what? They eventually will use that money for that purpose in the research of cancer, right? Okay, that's one type of temporary restricted purpose. Another type of temporary restricted, when we're dealing with some action of the not-for-profit, is equipment acquisition. Sometimes people will give money to a not-for-profit and they'll say, I want you to build a wing on the hospital and I want you to put my name on that wing of the hospital or something. So they make what? They make a contribution for a long-term purpose like what? Building or equipment, probably because they want to sit there for a long time, probably egotistical people, right? Or whatever, want to sit there for a long time. So see the John wing of the hospital, whatever, right? And so what happens? They make that contribution. They want it to be for long-term purpose, probably because they want to sit there and they want to be able to see how their contribution helped the community or whatever it is, right? So that is going to be what? That is equipment acquisition. So we've got purpose, like some research or something. We've got another activity that the not-for-profit would have to take to satisfy that restriction, which is to acquire equipment. The other way that we will have a temporary restricted is through the passage of time. Okay, so what happens? Somebody gives me a certificate of deposit. And they say, here's a certificate of deposit. You can't cash it in. You must hold it until it matures, and then once it matures, you can use it for the not-for-profit. So that's temporary restricted in that what? Time simply has to pass until that not-for-profit, I should say that certificate of deposit matures, and then they can use it for that purpose. Guys, I know we're getting late in the semester. I know that you're tired. I know that it's Friday morning, but we are about out of time. We are out of time for naps, okay? And that what? We've got today, we've got December 2nd, and that's it. And then we've got that mock exam on the 9th. So this is not a situation where you can tune out, start falling asleep and stuff, and then say, oh, I'll understand this later. Well, there is not much time left for understanding. And I promise you, when you're sitting there with that midterm in front of you and you're going, why don't I understand this stuff? You're going to be upset with me, and it's going to be your fault because you slept through the lecture, right? So sit there and focus in. If you got questions, ask them. That's what we're here for, to get this stuff down, and we don't have a lot of time left, okay? Okay, so we have these three categories: unrestricted, temporary restricted. We've described the situation for temporary restricted. Let's talk about permanently restricted. Okay, with a permanently restricted contribution, the donor says, here's a stock, and I want you to hold the stock forever. And you sit and you say, well, thanks a lot. Now what am I supposed to do, right? I just got to sit there and stare at this thing. Typically what they'll say is what? Any increases in value or any dividends that are paid off the stock can then be used, and they will often call out what it's going to be used for. So then the earnings off of that would be temporarily restricted, or they could say you can use that however you want in a not-for-profit. So the earnings would be what? Unrestricted, but the corpus, the principal, has to be held forever, doesn't it? In perpetuity. Sometimes they'll even say increases in value are permanently restricted because they're trying to, what? Protect that investment against inflation, right? So as the value goes up, as the general economy goes up, they want that investment, that corpus to what? To hold its position relative to the rest of the market. So they may make you hang on to some increases in value as well. And then they'll say any amounts over a specific amount, then you can use however for the not-for-profit, or again, they may temporarily restrict that. Okay? So we have what? We have three categories: unrestricted, temporarily restricted, permanently restricted, and I've given you a mnemonic there, which is what? Put, P-U-T, you put your money in a not-for-profit, and when you put it in, it is either what? Permanently restricted, unrestricted, or temporarily restricted, right? Okay, now what happens? Only donors can impose a restriction, right? Only donors can impose a restriction. So if I sit here and I tell you that a donor gave a contribution to the not-for-profit, unrestricted, and at a later date the board of directors, I always want to say specify, but there's another word for it, but I can never think of what that word is that I want to say here. The board of directors specified that that money is to be used for a preschool program. Is that money unrestricted, temporary restricted, or permanently restricted at that point? Huh? That money is still unrestricted because, as we said, only donors can impose a restriction on that money. So even though the board of directors, that's the word I'm looking for, thank you, God, can designate that money for some purpose, even though they can designate that money for some purpose, they cannot restrict it, right? And so any money that is what? The donor has not imposed a restriction on is automatically what? Unrestricted, even if the board of directors has designated that money for some purpose. Okay? Okay, so we have these three categories here for three categories. And for our temporary, notice I've put down here what? Purpose, equipment acquisition, and time is the nature of the type of temporary restrictions, right? Okay, so a lot of information on that slide, right, when you have to look at it. Okay, all right, so you come over and we take a look at our statement of financial position for our not-for-profits. And again, we've said that that is like the balance sheet, and we have our cash and cash equivalents. So we have our what? Our current and also what type of? Non-current as well. We're on full accrual accounting now, aren't we? Same thing for liabilities. We have what? Current and non-current. And then we come down to our net assets. What's net assets like? Good. It's like our retained earnings. And then again, we break them into our three categories. Unrestricted means it is what? Free of donor-imposed restrictions. And then what? Temporary restricted means that there's a donor-imposed restriction that can be satisfied through some action and not-for-profit. And then we have our permanently restricted. Again, principal is probably restricted, but principal is definitely restricted. And then we can probably use what? The earnings or increases in value for whatever in the not-for-profit, right? Okay. By the way, notice that the permanently restricted category works a lot like the permanent fund, doesn't it? Okay, and government. And notice that both have the word permanent on there. So a lot of similarity between the permanent fund and the way the permanently restricted net assets work in a not-for-profit. Okay? Okay, good. Let's talk about the statement of activities. What happens here? Statement of activities is one of the key things, one of the central things that we're going to focus on when we look at this material for our tests and stuff. Okay, a lot of questions that we're going to need to understand that relate to the statement of activities. Statement of activities is like the income statement, okay? And remember where we are right now in this part of the discussion for not-for-profits. We're just trying to understand the financial reporting structure, how the statements should be looked at, how the statements are used, right? That's what we're looking at this juncture. And so what happens? We have reported on our statement of activities, which is like our income statement. I guess I could put like IS here. Like IS. When we look at the statement of activities, it is like our income statement, and we have something called the change in net assets. And we're going to report the change in net assets. Change in net assets is like net income. If you think about it, if you didn't have dividends, you could call net income the change in retained earnings, couldn't you? Right? Net income is changed by retained earnings. So we don't call it net income in not-for-profits. We call it what? Change in net assets. Just like we called the net income of our governmental funds change in fund balance, didn't we? Okay. So we call it change in net assets, and we will report the change in net assets in all three categories of net assets. So we're going to give you a net income number for the unrestricted, a net income number for the temporary restricted, a net income number for the permanently restricted, and then of course we'll total those up and give you the total as well. But what? We are sitting here and putting it by category of net asset. So the way this statement will work is we'll show contributions coming in, and when we show those contributions coming in, they will come in either unrestricted, temporary restricted, or permanently restricted. Unrestricted meaning that the donor gave us the money that year, and what? There was no restriction on it. Temporary and permanently meaning they put a restriction on it, right? Then what? Then we will have something called a reclassification adjustment. What happens here? When we satisfy a donor's temporary restriction, in other words, we do what? We use the money to research cancer or something, we will show on the face of the statement of activities money coming out of the temporary restricted column and going into the unrestricted column, meaning that that money is now available for spending. And then of course we will show what? We will show the expense under the unrestricted column. So by definition, all expenses are considered unrestricted. They're shown under that unrestricted column because if we're spending the money, we are saying, hey, that money has now been released from restriction and we can spend it. And so we can show that we show that all under the unrestricted column. Okay, so since we're going to be focusing some time here and some energy on understanding and answering questions on our final related to the statement of activities, I went ahead and came up with an imaginary not-for-profit organization. Darn, I didn't want to tell you it was imaginary right at first. This takes all the intrigue out of it, right? Because some people think this thing is real, okay? And I have all your attention when you think it's real, okay? This not-for-profit organization, which is called Save the Canines, okay? And what Save the Canines does is it does what? It goes out and finds homeless dogs, whatever, and does what? Takes them in, cleans them all up, and then helps to place them and find them a home, whatever, right? Okay? And I've been using this example for a long, long time, and I would tell the stories about Save the Canines. And now this is a fairly broad area where a lot of not-for-profits do this work. They find homeless animals and they help to find them a home and stuff. No-kill shelters is what they call them now, okay, where they try to find the place the animal with a home or something. And these get pretty serious. I know that some of these, like if I place the dog with John, and then John later on turns around and says, well, I'm going to go ahead and I'm going to give the dog to somebody else. The not-for-profits will come and take the dog from the second home because they have not determined that that is an appropriate home for that dog. So they get pretty serious about this stuff, or cat or whatever it is, right? Okay, and so they have these organizations now. This one is Save the Canines. I've already told you it's imaginary. And the reason I eventually have to point out that it's imaginary, because I thought everybody knew it was a pretend organization, and when I would tell the story about it, and then one time somebody came to me and said, where is Save the Canines? Is it in Hayward? Okay, no, there's no such thing as Save the Canines, okay? So it's just an imaginary organization. But does anyone want to give some money to this? Who wants to give some money to Save the Canines? Megan, you want to give some money? Huh? Well, give some money in this imaginary situation, right? Okay. And so you're going to give some money, and you're going to give $10,000 to us, okay, in this imaginary situation. So I'm not going to expect a check for 10 grand from you at the end of this, okay? So you're going to give $10,000 to Save the Canines, and you're going to say that you want it to be used for the Fluffy program, okay? Fluffy program is the program where we buy doggy shampoo and doggy hair dryers and brushes and all that stuff that we can use to what? Clean up the dog so they can find a home, right? That's one of our programs. Well, we're trying to help a lot of dogs here, right? Okay, so as many as we can. So we're going to stockpile this stuff, okay? So you give us the $10,000. You say, I want it to be used for the Fluffy program, okay? So then what happens? Then we sit here and we don't spend any of your money, okay, that first year. We don't get a chance to spend any of it. So our expenses are obviously what? Obviously zero. Note, again, that we report our change in net assets. Change in net assets is what? Like net income, and we report it by category. Unrestricted is zero, net income, change in net assets, because nothing happened. We're up 10,000 on our what? Temporary restricted, thanks to Megan, who said, hey, use it for this program. And as soon as we use it for this program, we'll satisfy her restriction, right? So that's temporary restricted. And of course, nothing happened in the permanently restricted column. I circled the zeros here for beginning balance because we just started operation, didn't we? So by the end of year one of operation, we have only the $10,000 sitting there in the temporary restricted column, right? Okay. Now we go into year two. And when we go into year two now, we don't raise any money. So our contributions are zero. No fundraising has been done in year two. But we go ahead and we spend $6,000 the way Megan told us to, which is what? On this Fluffy program. So when we spend that money, we first have to show a what? Program restriction, reclassification adjustment, satisfaction of program restriction. The money comes out of the temporary restricted column and goes into the unrestricted column, signaling that that money has now what? Been released for spending because we've met the restriction, right? So it comes over, and then by definition, all expenses come into the what? Come into the unrestricted column, don't they? Okay, and so now when we look at our change in net assets, we are what? Zero in unrestricted because it came up by the reclassification. It came down by the what? By the amount of the expense, right? What about our change in net position for our temporary restricted? It came down how much? It came down 6,000 from what? What was it before? It was it's come down 6,000. What was it before? It was 10,000 in year one, so it's come down what? It's come down 6,000 from 10,000. So the ending balance is how much? Ending balance is $4,000, right? Okay.
In the real world, for not-for-profits and government accounting, with different categories of restriction, what safeguards are there to stop an entity from using money even temporarily? Well, I don't have anything right now to spend, but here's 20 grand. They said I have to use it for this. Can I just
But I'm
dip
going to
in
use
there
it
and
for
then pull it
that
back?
instead. Well, you mentioned two different entities there, governments versus not-for-profits. And what would happen for a not-for-profit if they didn't receive federal financial assistance, they would need to go through they would have their financial statements audited. And when they have those financial statements audited, the auditors would be looking to see, well, you had this contribution that came in that was temporarily restricted. And if you've spent some money, okay, because they're going to have to show that they spent that money, then there's going to have to be something that justifies this reclassification out of the temporary restricted and into the unrestricted. And so there would be some look to see that was that money spent for the purposes that the donor specified. Because if they've reclassed it, they're claiming that they've done what? That they've met the restriction, right? So in order to justify that reclassification, the auditor would look to see that that money indeed was spent for whatever the purposes of the donation were.
Right, but I mean, in real world practice, does it
I just gave you a real world example. Go ahead. That is real world. An auditor would come in the real world and they would look to see that they spent the money for the intended purpose. What? What's that upset response to my answer about?
doesn't matter for GAAP?
No, it doesn't matter. You asked me a question. I'm trying to answer the question.
I'm asking, in real world practice, when you have money that's classified, yes, it gets audited and they need to check. In practice, does it happen frequently where they will take some money and shift it around and say, even though it's classified for this, I'm going to use it for this, but then just put it back in there? And is it more of just being on the honor system, or is there some sort of physical, lockbox or something to that effect?
Well, they should have some sort of accounting system that would go ahead and be designated to say, well, this money is coded for this particular purpose. And so when that money is spent, it would code it that it was used for that particular purpose, and there would be some accountability in the system that showed that coding in the system showed that that money was used for that purpose. An auditor would come in behind that and audit that to see that indeed those codes were working correctly to show that the money was properly spent for whatever the purpose was. And so the safeguard is an audit, and if the auditor comes in and finds that they didn't spend that money for that purpose, then the auditor would say, in our opinion, the financial statements cannot be relied upon because they're saying that money had been spent properly and therefore was reclassified, and we found that they spent money and they hadn't properly spent it for the purpose, so it was not properly reclassified. We shouldn't have come out of temporary restricted and unrestricted because we hadn't met the donor's requirements. So they are not in compliance with what FASB wants not-for-profit entities to do when they spend money, which is so it coming out of the temporary restricted and into the unrestricted because they haven't spent that correctly. So there would be a coding that shows what those different monies are supposed to be spent for, and the auditors would bounce that up against whatever the specifications were of the donor. Okay, on a sample basis, they're not going to do it for every single one, but on a sample basis, they would look to see that that's all tracking correctly. Yes, so there are safeguards. Okay, if it's federal financial assistance that's going on, then we have a requirement by law that single auditors, because a lot of not-for-profits get federal financial assistance, and so there would be a auditor that comes in and the federal government has specific requirements of audit procedures that they want the auditors to do to make sure that there's compliance with the requirements of that program. And so they also receive a single audit. So if you're a not-for-profit, you have your financial statements being audited from the standpoint that I just described, compliance with FASB standards, but at the same time, there's an audit that's going on to make sure that you are in compliance with the specifics of the federal programs. And the federal government comes up with a 1,400-page compliance supplement every year in which auditors are to go through and look to see that for specific programs, and they don't have to go through every 1,400 page because not every not-for-profit gets money under every program, but they, in that 1,400-page document, they need to look up the specific program that the entity that they're auditing is getting money under and understand what the audit requirements are for that. So yeah, there's a lot of checks around this. Now, having said all that, you said, does it happen that they spent the money for some other purpose? Yeah, it happens. You know, there are times where you hear about a not-for-profit that I didn't follow the story that closely, but Wounded Warriors or somebody like that supposedly spent some money for some purposes that they weren't supposed to or something. So it does happen, and it's supposed to be audited, but hey, you know, we've learned the hard way that there's a lot of things that go down in industry, both for-profit and not-for-profit, that we'd rather would not, right? And the safeguards sometimes fail. But that's the structure that should be allowing us to be able to do this.
So there's no repercussion for not-for-profits, there's no law, it just would be bad publicity.
Oh, no, there's laws. Not-for-profits are chartered under the states. Okay, and if you were to violate some sort of restriction, etc., you could be probably subject to criminal civil penalties for that. Yeah. Oh, yeah. You can't take somebody's money and just then spend it for something else. No. Okay. And there would probably be disgorgement requirements as well, meaning that what if you spent the money and you know, even if you spent it for a beneficial purpose. I mean, you didn't buy yourself a Ferrari with it, you know, but you used it for some beneficial purpose. Even then, they could require you, the not-for-profit, to return that to the donors. So yeah, there's a lot of laws around this, you know, but it does get squishy. You know, we hear about supposedly Trump had a not-for-profit and he bought himself a picture of himself was what the not-for-profit bought. And they make that claim, oh, you know, that wasn't an appropriated cost. Well, okay, but you could get a little bit in the gray area there. Say, well, you know, it is his foundation, and it motivates more contributions when they see a 6-foot portrait of Trump. You know, so there's also, you know, little gray areas as well that come in, right? So. Okay, but most important now, what? We need to understand the mechanics of this thing, right? And so we now have, what, $4,000 left that we have to spend the way Megan told us to, the donor told us to, right? Okay, that's the statement of activities, okay? And just to review what we've already said about statement of activities, but now let's look at it again now that we've actually seen the example, which is what? Reports changes in all classes of net assets, unrestricted, temporary restricted, permanently restricted. Then what? Changes take the form of, you have the revenues, contributions coming in, right? And then what? Then we have the net assets being released from the restrictions like we saw, going out of the temporary restricted and into what? Unrestricted. And then we saw that all expenses are considered what? Considered unrestricted, okay? And I put stars on these on this slide, and the reason I did is because when I looked at this, you know, and I'm sort of looking at it as a summary, but I also looked at it and I said, this sounds like the type of questions we ask you on the exams, doesn't it? Okay, we'll say, which of the following would be something that is true statement about the statement of activities, right? And one of the right answers would be all expenses decrease unrestricted net assets, right? And I have students, oh, that exam was so hard. Meanwhile, it comes right off of one of the slides, doesn't it? Okay, good. Come over and let's just look at this example now, statement of activities now. And this one, yeah, got a little bit more traffic on it, doesn't it? And then what? You don't just have one contribution coming into one category. You have what? several contributions that can come in unrestricted, temporary restricted, permanently restricted, right? We can have investments. And if we have investments, we're going to have what? Income from those investments. And as I've said, they could have the income from the investment and say, hey, use it however. That would make that income unrestricted. They could have income from investment and the donor would say, well, you got to use even the income for a particular purpose. That would be temporary restricted. Or what? They could say that the income has to be permanently restricted. And again, that's probably like that 120 there. That's probably a situation where they've asked us to maintain a certain level relative to, the market value for a particular permanently restricted investment. So we got to put a little bit of that in the permanently restricted column. Okay, now the most important thing here is where I put this red box around, which is net assets released from restrictions. Now when you look at this thing, notice that what? It's just like Save the Canines, isn't it? Money comes out of the temporary restricted, goes into the unrestricted, doesn't it? Okay, now when you look, they've shown it for 3 different activities of the not-for-profit that resulted in the release of the restriction out of temporary restricted into unrestricted. And we have what? We have program, like research in cancer. We have equipment acquisition. And we have what? Time here, don't we? Aren't that the 3 ways that we satisfy the restriction that we said earlier? So we have another mnemonic here which will help us to remember how you satisfy the restriction, which is what? Program, equipment acquisition, time, pet, right? Okay, so put your pet in a not-for-profit organization, Save the Canines. You put the money into the not-for-profit, you help your pets either through what? Program, equipment acquisition, or time, right? And then as we've said, all expenses are by definition what? In the unrestricted column. Expenses are automatically unrestricted. Now notice that we have 2 categories here for our unrestricted. We have program A, B, and C. This not-for-profit's not very creative in what they call their programs, but they would have different programs. We have the fluffy program. Maybe we'd have the education program, but you have different programs, and you report your expenses by program, right? Okay. Then what? Then you have this area called support services. Okay, support services include what? Administration, management in general, and what? Fundraising. Okay, so support services are things that not-for-profits do to survive. So programs are what? Things that not-for-profits do. The support services are things that the not-for-profits do to what? Survive. Will Save the Canines last very long in this year 2 situation where we're not raising any money? We don't have much left, do we? We've got only 4,000 left now, and if we don't start getting busy with some fundraising, we don't have anything anymore, right? This not-for-profit is gone at this point, right? So since not-for-profits, like any entity, have to do things to survive, like generate resources, then we put that separately, what? Under something called support services, so that a user can look at our financial statements and say, okay, here's how you spent money to carry out the mission of the not-for-profit. Here's how you spent money to what? Simply support the not-for-profit's survival, right? Operation of the not-for-profit, including management in general. Okay, so we have to break those out. Now notice we report our change in net assets, which is like net income, and we report it as what? Unrestricted, temporary restricted, permanently restricted. We add those 3 up, and then we report what? The total of $15,450 here is the total of the net income, if you will, change in net assets of the 3 categories for this not-for-profit, right? That's the sum of unrestricted, temporary restricted, and permanently restricted. Hello? Okay. Okay, good. So we come over and we take a look now, and let's see what we have to say about the statement of activities. We have our program expenses and our support services. Program expenses are what? Are what the not-for-profit does. The what? The support services or things that not-for-profits do to survive, right? Okay. Now you come over and we give you examples of programs. For example, the fluffy program. If we're a what? If we are a hospital, things that are central ongoing would be what? Patient care. If we're a university, it's going to be what? Education. Some colleges are research, involved in research, right? Like Stanford, for example, I'm sure does a lot of research. So we may call out that program. Okay. Coming down, if it's support, classic example is administration and what? Fundraising, right, is something that is part of our support. Now, you could have a combined expense. Combined expense, when we spend the money, it has both a program and a support component to it as we spend that money. And we're going to have to allocate that appropriately between the what? Support category and the program category. For example, let's say we stipulate or we determine that the reason dogs are homeless is because people don't know how to care for the dog. So we decide to put on an education program in which we'll call people in and show them how to groom the dog and stuff, right? Okay, and for that reason, people will keep the animal as opposed to once, they're easy when they're a puppy, right? Then they get, oh, I can't handle it, and they just take it somewhere, right? Okay, so we're going to go ahead and put in an education program. How much would you be willing to pay for a doggy grooming class? We'll teach you how to groom a dog. How much you want to pay for it? How much? 200. Come on, give us 1,000. We're trying to help the dogs here. What's wrong with you? So you go ahead and you say, okay, right? And you give the 1,000, right? Okay, so what happens? We just had a program component to that, but there was also a little fundraising component to it, wasn't there? And then I got you to come up to the 800 for that, 800 more for that class, up to the 1,000. Okay, so what happens? Let's say I spend $10,000 on that class. I have to hire a classroom. Well, that's probably a little bit too much. Let's say I spend $5,000 on it. I have to hire a classroom. I have to hire a teacher that'll teach you how to do this. I have to hire a dog actor that'll pretend like it's a homeless dog and then be all happy at the end, right? So I have to get all of this stuff together, and so I spend $5,000, right? How much of that $5,000 is fundraising, because I have to report that as support, versus program? And I might sit there and say, okay, 20% of the $5,000, now I'm making the numbers hard on myself, what, $1,000 is going to be what? Is going to be program, and the remaining 80%, $4,000, is going to be what? Reported down in the support as fundraising, right? Okay. Now, I'm just sort of making up the allocation there. The takeaway is what? You have to allocate it somehow appropriately between its what? Fundraising and its program component when you have a situation like that. And we give you different examples here. For example, a golf tournament, where we're raising money and also doing something to help with our programs, etc. But the example I gave you is better than any of these. Okay? All right, so let's just go ahead and let's take a look at the statement of cash flows. Now, statement of cash flows is very similar to the commercial version, okay? So, unlike where with government we had to deal with that fourth category where we took the financing and broke it into whether it was capital or non-capital related financing, for the not-for-profit version, we don't have to do that. We simply have operating, investing, and financing as our three categories, okay? Then what? We can use the direct or the indirect method. Unlike what we saw for government where we had to use direct, FASB allows not-for-profits to also use the indirect method, okay? And then, of course, we have our investing and our financing, but indirect or direct method and when we report information for the operating activities. So you look at this next slide and a couple of key takeaways about how we treat items on the statement of cash flow specific to not-for-profit organizations. An unrestricted cash contribution is reported in the operating section. An unrestricted cash contribution is reported in what section, everybody? In the operating section, okay? If there is a restriction on a contribution, and that restriction is for a long-term purpose, so now somebody gives me cash and they say, I want you to acquire equipment with that money. Okay? If it's for a long-term purpose, then that contribution of cash is reported in the financing section of the statement of cash flows. So long-term restricted contribution, that money goes where? Financing. Good. Okay. Now, let's say they give me that money, they tell me to buy equipment, and they give me that cash. Is equipment a long-term item? Is equipment a long-term item? So when they give me that money, it goes into financing, right? Let's say a couple years later, I finally get around to buying that equipment. Where should I report the investment in that equipment when I spend that cash? What do you mean unrestricted? We're talking about statement of cash flows here, where our sections are operating, financing, investing. Poor little investing section. I mean, I even tried to tell you, when I make that investment in the equipment, where should that be reported? We report the spending of that money out of the investing section, right? Just like you would if you purchase equipment in commercial, right? Okay? The difference with a not-for-profit is, unlike a company who maybe would have to save the money over time to purchase this piece of equipment, whatever, we may get that financing from some donor where they've restricted it for that long-term purpose. It shows in the financing section. And then when we spend that money on the equipment, we show it being spent out of what? Just like you would in commercial, out of the investing section, right? So the money comes in as financing. It goes out as investing, right? Okay? With me so far? Okay? So you come over and you take a look at this statement of cash flows, and I'm just going to make this the appropriate size so we can see what the heck's going on here, okay? Is this the direct or the indirect method? Huh? Say it loud so I can hear you. Oh, now you're not going to say anything. Is this direct or indirect? Good. This is the indirect method. Very good. Why? Well, we're starting with the change in net assets, that 1540. Remember we saw that on the statement of cash flows, the statement of activities a couple of minutes ago? We take that total change, that's our total net income, isn't it? So we don't start reporting by category. We don't have 3 columns on the statement of cash flows. We just take the total column, don't we? Okay, and so we have what? We have our change in net assets. So this is the indirect method, isn't it? And that we started out with our change of 1540, right? 15450, I should say. Okay, so we go ahead and we have that 15450, and then we start like you do with the indirect method, add back depreciation, then what? Decrease in inventory, all our current assets, current liabilities. We calculate the change in those and making our adjustments to cash provided by operating activity, or I guess in this case used by operating activity, right? Is this the indirect method? Okay, now notice something here. We have this interest and dividend restricted for long-term purpose, and they show that as a subtract. So they're reporting interest and dividends as a subtract in the operating section, and it's for long-term purposes. Where are we supposed to report interest items for long-term purposes? Are you guys having short-term memory loss already? Where do we put things that are supposed to be for long-term purposes when we have money coming in for long-term purposes? It's supposed to be in financing, isn't it? But what's happened? We've started with this, what? Total change in net asset number, which includes what? The changes in everything. Unrestricted, temporary restricted, permanently restricted, including something that would have been what? Temporary restricted for a long-term purpose, isn't it? So what's happening? Since we started our operating activity section with this what? Net income number, which is, change in net asset, which is like net income number, which includes what? Both unrestricted and temporary restricted items. We got a little problem, don't we? So we're going to go ahead and we're going to back this out of the what? We back it out of unrestricted. You see it right there, that 300. Can you see that little hand up there? We're going to back it out. I can't draw on it because I have it zoomed, and it won't let me draw when it's zoomed. We back it out of the operating, and we include it in down here under what? Is it under financing now? Is it where it's supposed to be now? Because we started with that net income number, which includes everything. Restricted, temporary restricted, permanently restricted. It starts out in the wrong category, doesn't it? And so what do? We back it out of there, and then we include it down where we want it, which is in financing section, right? Isn't that a mess? Whose fault is it that it's a mess? That you have to do that. It's FASB's fault. Why do they have this indirect method? They should just get rid of it. Here I go again with the indirect method. I was mad at it for government. I'm mad at it again. What? If we just use the stupid direct method and just use that, we could sit here and say cash received from donors, cash paid for programs, and we wouldn't be burdened with this stupid coming out and going back down. We would just then be able to put what? A long-term donation is down in the financing section. Wouldn't it work much better? They need to get rid of this indirect method. I'm tired of it. It's the reason you don't like the statement of cash flows. You think you don't like it because you're afraid of the direct method. You actually don't like the statement of cash flows because of the indirect method, because it creates all this weirdness. Okay? Okay. So let's go ahead then and let's take a look at the statement of functional expenses. Okay, now this is the one statement that needs to be prepared by voluntary health and welfare organizations. They're the ones that must prepare this. The others, the hospitals and the colleges, are encouraged, but they are not required, right? Voluntary health and welfare organizations have to prepare this. Now, to help us understand this statement of functional expenses, we first need to take another look at the statement of activities for this entity. Okay, so here's my statement of activities. This is for a voluntary health and welfare organization. And notice when we get a contribution, the contribution comes in what? Unrestricted, temporary restricted, or permanently restricted, doesn't it? There's our contributions, just like we saw before. Then what? As we satisfy those restrictions, are what? We satisfy the restriction, we show the release out of the temporary restricted into what? Unrestricted, just like we saw before. And then all expenses are by definition what? Unrestricted. If we're spending the money, we've met the restriction, right? Now, I want you to focus on one program here. See this research? See research 1414? You see that research? See the total? They spent 1414 on research, didn't they? When we go to the statement of functional expenses, statement of functional expenses allows us to see how they spent money on research and, of course, their other programs. But let's focus on research. You see research right here? See research? You come all the way down. Is that 1414? So we know they spent 1414 on research, and what this is going to do is give me details to exactly, maybe not exactly, but pretty much how they spent this money, right? And you take a look and you say, well, they didn't pay many employees for research. And you keep coming down and you look and you see, awards and grants 1332. Isn't that pretty much the bulk of that 1414? So this not-for-profit doesn't do the research. They do what? They go and they find entities that are worthy of an award to do the research, right? So when you contribute to this not-for-profit, you would want to know, is it one that does the research directly, Or is it one that is going to go and take my money and hand it to somebody else? You may sit there and say, no, this is not the entity I want to give my money to. I want to give my money to one that's doing the research directly, whatever, right? And you would be able to determine that by coming up with this statement of functional expenses. Now, it's a very useful statement for that purpose then, isn't it? Okay, I am of the opinion that the statement of functional expenses is the most important one of the statements that we have here. I think it's more important than the statement of activities, more important than the statement of financial position, more important than the statement of cash flows, because it's giving me a lot of detail as to how they spent their money, right? Now, the reason they required it for the voluntary health and welfare organizations like United Way is they were getting into some trouble where they were getting all these donations and then they were paying their executives these nice big giant salaries, and everybody was like, this is crazy. Why are we giving you this money to pay an executive to sit up there? No, we want the money to go what? More towards the the care or whatever it is that they're supposed to be doing. So this gives us much more detail as to how that money's being spent, and it's not all being spent on somebody's salary or payroll or whatever, right? Okay. I actually was involved. I wasn't involved. I had a friend that worked at GAO, Government Accountability Office, where I worked for 30 years, and at some point one of our we had like this little group of individuals that got very close over the years. And one of those individuals went to work for City of San Jose. So he calls me one day after he had left after a year or so and says, hey, John, can you help me out? I've got this situation where I've been assigned to an audit. There's a not-for-profit entity that receives a fair amount of funding from the City of San Jose, and we now have an audit request to look at that entity and see how they're spending the money that has been provided by the City of San Jose to them. I have their financial statements. Can you help me look at these and figure out what's going on? Not everybody in GAO is a CPA, and this guy was not an accountant, was not doing assurance work, so he didn't know how to read financial statements. So I said, well, buy me lunch. I'll come down and I'll do it. So we go down and we look, and I grab this statement and I start looking at it. And after a while, we looked and we realized that that particular not-for-profit was doing what? Was spending more money for a consulting contract on fundraising, which we were able to get from the statement of functional expenses. They were spending more money on a consulting contract for fundraising than the amount of funds that were being raised by that entity that they consulted to do fundraising with. So there's a waste of the city's money. Why are you paying a contractor to raise money and they're charging you more than they raise? And it turned out that the not-for-profit didn't do a good job in negotiating how that contract was going to work. Most contracts like that should be on a contingent basis, right? You raise this much, you get a percentage, right, of that, and not just a fixed fee for fundraising. That's ridiculous, which was the type of contract they had gotten into. But and of course, we had to look at more detail, I just kind of pointed that out, that number looked funny to me, the way they were spending so much money on fundraising. And then he went and he looked and he said, you know what, here's the finding that we had. And so it helped them to find it, though, by looking at this thing. They had to get more detail, of course. Okay, good. So that is the statement of functional expenses. Okay, not required for the colleges, not required for the hospitals. It is required for the voluntary health and welfare organizations. Okay, good. Let's do this. Let's take the break now, and we will come back, in about 10 minutes, and we will start to get into how we're going to recognize our contributions, how we're going to recognize our expenses for the not-for-profits, okay? All right, guys, see you in about 10 minutes. Uh-huh.
Do they ever get like contracts where you promise to contribute a certain amount, or is it just totally voluntary? If I was a city of San Jose and I found out that they were doing that, I would, cut them off.
And our expense recognition requirements. Okay? So, first off, let's talk about just pure revenue. Pure revenue. Not contribution, just straight up revenue. The not-for-profit does what? Provides a service and what? And charges for that service. That's revenue, and they can take that revenue as they have provided that service as the money is earned. For example, go back to Save the Canines. Remember we did the doggy grooming class? What if somebody comes up to us and says, hey, I want to take a dog home, but I realize after going to this class that I'm not going to be able to do the grooming. I'm too busy. I'm afraid I'm going to, cut the dog when I'm clipping it or whatever. I'm not patient enough to bathe it. Will you please do this once a month for us? Or I don't know. Well, yeah, you don't take a dog more than once a month for that kind of thing, I don't think. The dog, will you do a doggy spa for us, right? And so what happens? The light goes on for us and we say, hey, that's a good way for us to raise some revenue. So we say, sure, take the dog home and we'll charge you, $50 a month to groom the dog, whatever, right? And so now we're making revenue, right? When we earn that revenue, it is automatically considered unrestricted. The person that is receiving that service from us cannot dictate to us how we are supposed to spend that money because we've earned it and we can spend it however we want to help out the not-for-profit, right? Now, side note, not-for-profits have to be careful with something like that. They cannot all of a sudden start pulling down big chunks of money by providing some sort of service out there like doggy grooming. Our charter is not doggy grooming. Our charter is what? Our charter is helping to place animals, right? And so we can't all of a sudden sit there and be getting this big chunk of money from doggy grooming. If we do, the IRS will step in and say, now you are subject to the unrelated business income tax. And they're going to literally are not-for-profits taxed? Other than the situation I'm talking about now? Not-for-profits, and it's kind of one thing we all understood that. I probably should have mentioned that up front. Not-for-profits are not taxed, right? Unless they get involved in a significant amount of unrelated business income tax, then the IRS will come in and say, no, you got to pay tax on that portion of your revenue that's coming in, not contributions, but the revenue that you're earning there, right? Why does the IRS do that? Why does the tax law have that provision in there? And why don't they just let Save the Canines raise all the money they want from doggy grooming as long as they use the money to help the dogs? Huh? I don't think that's their concern so much. You talk about tax evasion, the IRS trying to stop that. I doubt that the IRS is holding meetings right now saying, hey, let's go after them, not-for-profit shelters, man. We got to get some money out of those guys, right? So that's maybe a minor concern, but there's something else. You mean the IRS is turning over rocks to find money and not-for-profits are a rock? No. That line, I was at a hearing. There's this, there were House Ways and Means Committee. At that time, the chairman was Charles Rangel, who is the representative from New York, Harlem in New York. Did I tell you about this guy? And he's got this funny way of talking. He's like, what are you talking about? And so during the hearings, they're talking about taxing credit unions. Credit unions are not-for-profit entities, and Congress was talking about taxing them. And Senator Rangel says to the credit union person that was testifying, says, you, madam, what this committee is doing is this committee is looking for revenue anywhere they can find it. And so they're turning over rocks to find revenue. And he says, you, madam, are a rock. Okay, so anyway, it's kind of a funny thing. There's these hearings. When you go to a congressional hearing and you're actually there, what you realize pretty quickly is it's a made-for-TV movie. They got the lights up there and everybody's acting one way. And then once the hearing starts, everybody puts on their personality, right? And then when the thing is over, everybody goes back to normal bureaucratic, governance. So anyway, no, I don't think they're trying to get revenue out of this. Here's the problem. If I let a not-for-profit doggy groomer raise all the money it wants through doggy grooming, what's going to happen to the for-profit doggy groomer? They're going to go out of business because the not-for-profit, it doesn't have to pay tax, so they can what? They can bring their price point down, and they'll steal all the business away from the for-profit doggy groomers, right? So that provision in the Internal Revenue in the laws are what? I shouldn't say it's in the code, but it's a law that what is there to protect for-profit entities, right? Okay, so a not-for-profit has to be careful. They can't get too big in this area, but they can have a small portion of their overall support that comes in through what? Through revenues. And the takeaway from this slide is those amounts are automatically what? Automatically considered unrestricted. Okay? Okay, good. Now you come over and they give you examples here of the type of things, program service fees. All of these would be considered revenues. Okay? Now, when we talk about support is where somebody just gives us money. They give us money out of the kindness, out of their concern for the objectives, for the mission of the not-for-profit, for the charter of the not-for-profit. Okay? Now, when they give us cash, that is considered a contribution, and we can take that cash contribution when the cash is received. So if somebody gives me cash, what should I debit? Cash, okay. Somebody gives me $10,000, I debit cash 10,000, and I credit what? What? I credit contribution, don't I? For 10,000? Right? Okay. Now, what happens if somebody doesn't give me the cash up front? They pledge, they promise to give me the money. If they promise to give me the money, then I'm going to debit PR, which is pledges receivable, for 10,000, and I'm going to credit what? Contribution, because they're going to give me that money, aren't they? They promised to give me that money? Okay, so a pledge can lead to recognition of contribution. Obviously, the cash leads to the recognition of a contribution, right? Now, when we look at these pledges, we look at these promises to give, we have to be careful about the nature of that promise before we go ahead and just recognize the contribution. So what happens? If somebody gives me, I keep forgetting that we have this slide in here, and I jumped to what's supposed to be on the next slide. Now I got to rewind and back up. Let's start. When those contributions come in, they come in either what? Unrestricted, temporary restricted, or permanently restricted. Unrestricted means it is what? Free of donor-imposed restrictions. Donor puts restriction, either temporary or permanent. It's going to be in those categories. And we saw how that statement of activities works, right? Now, let's go back to pledges. When they give me a what? A unconditional promise to give, I can take that pledge as soon as the promise is given. So somebody comes in and they say what? I promise I'm going to give you $10,000 no matter what. I debit what? Pledges receivable for $10,000. I credit the contribution because they've promised no matter what they're going to give me that money. That's considered what? Unconditional promise to give. Okay, and I can take that contribution, report that on the statement of activities as soon as the pledge is made, right? Okay, now what happens? Somebody could give me a conditional promise to give. And if they give me a conditional promise to give, then what? The condition has to be met in order for me to take that as a contribution on my statement of activities. So, let's say a person says, I'll give you $10,000 after you have found a home for 10 dogs. When can I take that contribution? After the 10th dog. Sometimes we'll see that there will be questions where they'll say, well, they found a home for 5 dogs. What should they do? And the temptation to say, oh, well, they can take 5,000. No, it's got to be what? 10. Okay, not 9, not 8. Got to be what? 10, right? Okay, now what if we find a home for 9.5 dogs? Okay, well, what's happening? That means the 9th dog is going to have pups at some point, right? And we've said, okay, and then we might be able to wiggle through and say, okay, close enough, go ahead and take the contribution because this one dog was going to have pups and, we helped find her a home on a farm somewhere. I don't know, but whatever it is, right? Okay, and so, but it's got to be substantially met, doesn't it? What happens if I tell you I'll give you $10,000 when I die? What has to happen? The person has to die in order to take that 10,000. Now look, the not-for-profit doesn't hire a hitman. Hey, go out and you take care of this, and we'll make sure that you get a piece. It's not that bad. And they don't say, I saw the guy the other day. He's not looking too good. Let's take the contribution, right? It has to what? It has to. The person has to be. They have to be notified that the person has died. Okay. All right. So these are conditional promises to give. You take the what? You take the contribution when the condition is substantially met, right? So cash contribution, take it as soon as you get the cash, right? Unconditional pledge, take it as soon as you get the pledge, right? Conditional pledge, you have to what? Wait until the conditions are met, right? Now, what happens if somebody gives me, and I don't know why I wrote this 5,000 down here. I was probably talking about something else before. Don't worry about that. But what happens if somebody gives me a unconditional promise to give and tells me I have to use the money for the Fluffy program? Where should I show that on the statement of activities right here? Unconditional promise, say I have to use it for the Fluffy program. Unrestricted, temporary restricted, or permanently restricted? It is temporary restricted, good, because they told me I have to use it for some purpose, right? So even though it was an unconditional promise to give and I debited what? Pledges receivable and credited contribution, when it shows up in the temporary restricted column, doesn't it? Right? What happens if someone says, I will give you $10,000 after you find a home for 10 dogs, and I found a home for 10 dogs? Where should I report that on the statement of activities? Nowhere. I have not found a home for 10 dogs, so I don't recognize it, right? This conditional versus unconditional is telling me whether it's going to be reported on my statement of activities. If I haven't met the condition, I don't take the contribution, so it's not showing here, right? Right? Okay. What happens if somebody gives me, pledges that they'll give me $10,000 after I found a home for 10 dogs and I find a home for that 10th dog? And they tell me I can use that money however I want in the not-for-profit. And I found the money for the 10th dog now. What should I do? I'm going to what? I'm going to debit cash now. Credit, well, let's say they haven't paid me yet. I'm going to debit pledges receivable. I'm going to credit what? Contribution, because I found the home for the 10th dog. And that's going to be what? Unrestricted, because they didn't restrict how I use that money, right? Okay, so I'm doing this little exercise here so that we realize that there's a difference between restriction and what? Conditional, right? I can have a unconditional promise that's restricted. I could have a conditional promise that is what? Unrestricted, right? Okay, so when we have a conditional promise, it is simply, when we're looking at conditional versus unconditional, it is simply what? When we can recognize that, not what column we put it on. Okay? Okay, good. So you come over and you take a look at this next one, next slide. And what happens if our experience tells us that some portion of our contribution pledges will be uncollectible? Okay, so we're talking about, say, unconditional promise. Person promises they're going to give me $10,000, or a number of people promise they're going to give me some money that totals $10,000. But my experience says that 1% of the time I don't collect on that. Can it happen? To not-for-profit? Yeah, someone's had a few beers, and they say, let me call up the doggy place and give them $10,000. And then they wake up the next morning and they go, I'm not sending that dog place $10,000, whatever, right? So sometimes people don't send us the money for whatever reason, right? Okay? Notice what we do. When we get the pledge, if 1% of our experience tells us 1% of the time people don't pay the pledge, we are required to take the pledge receivable gross, right? And then what? We credit the contribution for the portion we think we'll collect, and we're going to credit the allowance for the portion we think we are not going to collect, right? That little journal entry up there in the corner? Okay. Is this just like commercial? I love to throw that curveball. I throw you that. It's not even a curveball. I throw that pitch to you, and you swing and miss at it every single time. I don't know what it is about that pitch. That's my go-to pitch. I throw that one, and you guys swing at it 3 times on one pitch. It's great. Is that how you do it for commercial? Strike 2. Is that how you do it for commercial? You're out of there. Okay, that's strike 3. Is that how you do it for commercial? Uncollectible amounts. Okay, how do you do it for commercial if I have an uncollectible amount? I've got revenue of $10,000 and there's 1% not going to be collectible. What do you want me to do here? Give me the full set of journal entries. I'm just going to call it allowance. $10,000, 1% is not collectible. $10,000, 1% not collectible. Is it 1,000? I mean 100, right? Debit bad debt expense, how much? 100, and credit the allowance, how much? 100. How about the sale? Do you want to record the sale? Sale is going to be what? Accounts receivable, 10,000, and what? Revenue, sales, whatever, 10,000. Right? So we didn't do the same thing. We reduced our contribution by the amount that experience tells us we're not going to collect to set up the allowance, right? Why did we do that? Why do we do that? I mean, think about this. In a governmental, when we were using modified accrual accounting, we did something similar to this. We reduced the revenue by the amount that we thought we weren't going to collect. But at that point, we pointed to the measurable and available criteria and said, well, if we're not going to collect it, it's not available, so we should reduce the revenue by the amount we're not going to collect, right? But we're not on modified accrual. We're on full accrual accounting now, aren't we? So why are we sort of taking this modified accrual accounting approach to this, okay? And the reason is what? We say that if a donor has a conditional promise to give, we shouldn't take the revenue for that, right? If it's a conditional promise, we shouldn't take the revenue for that? Okay, well, if someone decides not to pay us, then they must have had a condition, even if they didn't state it to us. They must have looked at the situation and said, I don't think so. I don't think that not-for-profit has met what I want them to meet, right? And so that was, even though it wasn't stated, those amounts you don't collect are seen as a conditional promise to give, right? So we reduce the contribution by the amount we think we're not going to collect. Okay. Now, the reason this starts to get more important here, and I'm pointing out the commercial approach, is what? If the not-for-profit has provided service like doggy grooming, we bill the people for that service, and they don't pay us, then we do that we debit the bad debt. Our experience tells us that people aren't going to pay us at the time that we provide that service. We would debit the bad debt expense and credit the allowance because what? This is now an exchange transaction going on for the not-for-profit, right? So when it's a non-exchange situation, a contribution, we do what? What you see up here, which is to reduce the revenue, the contribution, I should say, by the amount we're not going to collect. When we are dealing with what? An exchange transaction, when the service has been provided, the not-for-profit then takes the commercial approach, right?
So they take the commercial approach when they don't get paid?
No, they take the commercial approach when they have provided a service, like doggy grooming, and they're billing somebody for that service. Then they do this. They would recognize the revenue, gross, take the receivable, gross. They would debit the bad debt expense, credit the allowance. If they've provided a service, it's been an exchange transaction. If it is a non-exchange transaction, in other words, a person is contributing money to us, and our experience tells us that 1% of the time people who told us they'd give us money just don't do it, then if that's the case, we do what? We do sort of the net, what we'll call the net approach, if you will, where they'll put up their pledge receivable, but they'll reduce the contribution by the amount their experience tells them they won't collect. Okay? Okay, good. What about a long-term unconditional promise? So instead of someone saying, hey, I'm going to send you the money, the check's in the mail, you'll have it at the end of this month, somebody says, well, I'm going to give you $500, but I'm going to give it to you in 2 years. Well, now we're getting into what? A longer-term situation as to when we're going to get that money. And so we still take the pledge receivable, but now FASB tells us that we have to use present value accounting for that. So I know that on a present value basis, $500 is less than $500, isn't it? On present value basis, right? Okay, so what do? At the time of the pledge, I will debit pledges receivable, and I'm just made this number up, 475, because I know it has to be less than 500, doesn't it? So I'll debit pledges receivable, 475, and I will credit the contribution, 475, using present value accounting, right? Okay. Then what? Then the person goes ahead and pays me 2 years later. And when they pay me 2 years later, they're going to give me the full 500, aren't they? So I debit cash, 475. I credit the pledges receivable. I debit cash how much? 500. I credit the pledges receivable, what? 475. And then I credit contribution, $25 for the difference between the previous recorded present value and the actual amount received, right? And you can see that that's specified right here, that the additional amount received when it's finally paid is considered contribution, not interest revenue or anything like that. Okay? Okay, good. And I think I put a bunch of stars on this page because I look at a page like this, I look at slides like this, and I see, I don't know, maybe 4 or 5 multiple choice questions right there. Okay? Okay, good. Come over and let's take a look at donated materials. What happens here? Well, people like to give not-for-profits not always money. They like to give them things, right? So I don't know. What is that place? Pet what? It's a place where you buy pet things? No, pet something. It's PetSmart. Or is there a Petco? Whatever. One of these big outfits. Okay. So what happens? They sit there and they want to, help out some not-for-profits. So they say, hey, not-for-profit shelters, we're going to give you a bunch of doggy supplies, toys and, what do you call them, leashes and collars, all that kind of stuff, right? Doggy sweaters for the winter, whatever. They give us this stuff. So what happens? When they give us this stuff, we do what? We debit materials credit contribution. So all we've done is replace the debit from cash now or receivable to what? to some sort of inventory materials or whatever they were giving us, the credit is still to what? Still to contribution, isn't it? Okay. Okay, good. What about if someone donates services to us? Okay. Should we recognize the value of that service? Well, when we look at services, we look at them in two categories. One is if the person is just simply donating a straight service to us versus somebody is donating a service that creates or enhances a non-financial asset such as a building. Okay, let's talk about that. Someone's donating a service and that service is resulting in a non-financial asset such as a service or a building. For example, we call somebody in to come and build doggy kennels for us, right? Can't have these dogs running around wild all over our property from Save the Canines, so we now start to build little doggy kennels, right? The guy comes in, he's building the doggy kennels. He announces at the end, no charge for this. I always wanted to help animals. You're helping animals. This is my contribution, right? Should I recognize the value of that service? Did it create a non-financial asset, like a building? Yes, it did, right? So I need to recognize the value of that service because it's done what? Right here, first bullet here, it's created or enhanced a non-financial asset such as a carpenter providing us with a building, whatever, right? Okay? When that's the case, I make this journal entry right here, this first one here. I debit building and I credit contribution, right? Because that person didn't charge me for that. So I debit building, I credit what? Contribution. As opposed to having to credit in cash when I pay the guy for his invoice, right? Instead I do what? I credit contribution. Okay? What happens if the service that is provided does not create a non-financial asset such as a building? Now it's a veterinarian that comes in. And the veterinarian comes in and they're charging us $100 a month because we want them to periodically, monthly check the general health condition of the dogs, etc. And they come in once a month for the first 6 months of the year. On July 1st, they announce no more charges. I'm trying to help animals. You're trying to help animals. I'm not going to charge you for the back half of the year, right? Okay. Have they donated a service to us? They have donated a service to us, but we need to look at that service to see if it meets the criteria for recognition when it's a service that has not created or enhanced a financial asset, non-financial asset like a building. So what happens? Well, we need to look to see if it is a specialized skill, is typically or otherwise needed by the not-for-profit, and is measured easily, which this slide didn't include that, but that is an additional criteria. And so we have three criteria here in order for us to recognize the value of recognize a service that has been donated. The service, of course, that does not create or enhance a non-financial asset. It has to be a specialized skill. It has to be what? Otherwise needed by the organization, and it has to be what? Measured easily. In other words, we recognize that donated service some of the time, don't we? When it meets these criteria: specialized skill, otherwise needed, and what? Measured easily. So would this example meet the criteria, the veterinarian? Is it a specialized skill? Very specialized. Veterinarians have to study harder than people doctors, don't they? Because they have to know how to do what? How to cure a dog, a cat, a frog, a snake, whatever. All these different animals, pigs, different animals that people bring to them, right? Okay. And what? They have to treat a patient that can't speak. The dog can't go, ho, 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 so we just got to figure out what's wrong with him, right? Okay. So we have what? A specialized skill. Was it otherwise needed? We were already hiring that person for the first 6 months of the year, so obviously we needed that, right? And is it measured easily? Yeah, we were being charged the first 6 months. Just take the back 6 months and set that up as what? as what the charges would have been, right? Okay? And so what happens when it's a donated service like that that doesn't create or enhance a non-financial asset, since it's a service, debit service expense. Here, guys, they're debiting salary expense because they're assuming that nurse contributed her time to the hospital. She's a regular worker at the hospital, and she contributed her time. And if that was the case, you would debit salary. But if it's the situation I'm talking about, like the veterinarian, I might debit what? Professional service expense or veterinary expense, depending on how granular I want to get on my financial statements. And I'm going to go ahead and do what? I'm going to go ahead and credit the contribution for that, right? Okay. Now, what happens if a retired CPA comes to the door and says, hello, I want to help? And we say, well, look, we have a CPA firm that's doing the work for us. We don't need any auditing or bookkeeping or, tax prepared and done. By the way, not-for-profits do prepare a informational return to the IRS. It's Form 990. They have to prepare that and file that with the IRS, okay? But they sit there and they say, we don't need any help there. And I say, well, I still want to help. I've been an auditor all my life. I've never helped anybody. Please let me help, right? And so what happens? They give me a shovel, and they ask me to go in the back and help with a little of the cleanup that's obviously going to need to be done at Save the Canines, right? Should they recognize the value of that service? Look, it's not a specialized skill. I don't know how much it was otherwise needed, and I don't know how exactly you measure the value of that service. So it has to meet all the criteria, though, right? And since it's not a specialized skill, we don't recognize the value of the service. Now, why did I make that a CPA? Because a CPA is a highly skilled individual, aren't they? Okay, but just because the individual is highly skilled isn't what we mean by specialized skill. We mean that they are providing you with their specialized skill, right? Okay, so you need to look at that. All right, I had a student one time that told me that they go with Habitat for Humanity, and they go with their firm and they help do things like clear weeds around where they're going to build up some housing and that kind of stuff, right? Would we recognize the value of that service where the CPA firm goes and helps clean up the weeds? No. How about this? They will have like a CPA firm go and they'll hang up sheetrock. Now, hanging up sheetrock can be a little bit tricky, right? I mean, you don't want the sheetrock crooked, or weird shapes, of sheetrock, So you're going to have somebody like a carpenter there that says, no, you got to nail it this way. No, cut these this way and put this that way. There you go. Now you got it. And they have one supervisor doing that, right? And that person's a carpenter. Should Habitat for Humanity recognize the cost of the CPA firm people that were hanging the sheetrock? No, because they were not providing specialized skill. How about the cost of the supervisor? Yes, that supervisor is providing you a specialized skill at that point in time, right? So you would, and even if they volunteered, you would recognize the value of that service. Okay. So you got to look to what the services are being provided. Okay, let's look to, and if it's being provided by someone who has that expertise. Let's go ahead and let's take a look at gifts in kind. Gifts in kind are non-cash gifts. What time do we get out of here? Okay, yeah, we got it. Perfect. So we got non-cash gifts. Okay, non-cash gifts are called gifts in kind. Again, people give us stuff. So what happens here? Have you ever been to a silent auction? A silent auction. They lay all kinds of stuff out on tables, and then you're supposed to come up and bid on it, and you do it for a good cause or whatever, right? Usually at a silent auction, there's alcohol served so that people will get a little bit tipsy and start having fun with the bidding process, right? Okay, so what happens? To get people to do this, we'll go to different organizations, and we'll say, will you please donate Giant tickets? We'll go to the Giants and say, will you please donate San Francisco Giant tickets? And they'll say, yeah, okay, sure, we'll do that to support the community. And we go to the different, places and get different things. We ask Apple to give us an iPad or something, and we get all these different things, and then we lay it out on the tables, and people bid on that, right? Okay, so what happens? When we originally get, say, the tickets, we will go ahead and what? When it is donated, the tickets are donated, we'll debit ticket and we'll credit contribution because somebody has contributed an item to us that has value, right? And if the tickets were $50 each, the fair value of those tickets, 50 times 2, is $100. We debit tickets, we credit contribution $100, right? Then what? Then we hold the silent auction and people start to get a little bit tipsy. And I don't know, I've been to these things where I've seen two friends sit there and they start competing against each other for the same item. They're having fun. They'll say, did John bid on this thing again? They'll keep coming back and two people will get in a bidding war against each other in a friendly little thing there while everyone's having a good time, right? And so let's say we bid up those tickets, and it's all for the good cause, right? We bid up those tickets and we bid them up in excess of what? In excess of the $100. So finally one person wins out, right? And so what happens? We make that person give us the $150 cash now because they bid these tickets up to $150. We'll credit tickets $100 and we'll do what? We'll credit contribution for the excess, right? Which is what that area that I circled there is telling us we need to do. Question? The question last night was, well, what happens if, the Giants aren't doing too good that year and nobody wants those tickets or nobody gets drunk enough, whatever, and they only billed for the tickets $75. Well, if that's the case, we would do what? Obviously, debit cash 75, credit tickets for the 100, and debit contribution for the 25. We call that a change in accounting estimate, even if it's not until next year. That's a change in accounting estimate. You simply do what? You go forward with that new estimate, don't you? You don't have to go back and restate anything. Okay? Okay, good. Come over. And let's take a look at situation where we give away stuff to people to acknowledge their contribution or to encourage their contribution. For example, we give a doggy calendar, 12-month doggy calendar, and we're going to have a picture of a dog on each month. So we sit there and we say, well, we got to hire a photographer. We got to hire dog models, and we got to hire what? We got to hire a printer to print these calendars, and each time you give $10,000, we'll send you this beautiful doggy calendar, right? For Save the Canines. The cost of that calendar, of all that printing and hiring of the photographer and the dog models and all that, that is all considered fundraising expense. So if you spend money to create items like a calendar to acknowledge or encourage donations, that is considered what? Fundraising expense, right? Okay. Okay, good. So we're right where we want to be. Okay. What we're going to start to get into when we come back next after the holiday, 2 weeks from today, is we're going to go ahead and we're going to start to talk about the third category, which is sort of these specialized areas, right, for not-for-profits. And then we'll get into chapter 15 and 16, and then we will just dedicate our time in the back end of that class to, I guess, that mock exam we were talking about. Okay? So in the meantime, what I need you to do is I need you to look at the homework file that if isn't it up on iLearn yet, I'll get it up there right now. I'm going to do it before I walk out of here, okay? And I'm going to put that homework file up there, and it's going to contain a bunch of questions about not-for-profit. Go through them and see to what extent you can work those based on what we already understand. There's probably a couple that you'll be like, huh? That's probably going to be one of those specialized areas. Okay, do that, and what we'll do next time is after we finish up the additional chapters, we'll go through that first practice midterm, and then maybe what we'll do is take one of the other ones as a mock. Okay? Okay, guys. Have a good rest of Yeah. This one? Huh? No, I'm not in a particular rush.
gonna go over my transcript. Do you want me to
Oh,
print
okay.
it out, or I have it on my computer? Or would it be better if I go print it out?
It's probably easier if you print it,
If I
but
print,
you
okay,
don't.
I'll go print it out, then I can come back.
I'll wait here. Yeah,
Okay.
I'll wait here for you. Yep.
Okay. Thank you.
Okay. Hi. How are you?
Good, how are you?
Good.
So for the CBA exam, I mean the CBA application, um, this one they have a question about work experience. So I put like, is that the internship count as work experience for?
Yeah, but why are they asking about work experience?
I couldn't open it now, so I cannot show you in the laptop. So, but I took a picture like
How
last
much
week.
work experience must you have in accounting
Yeah.
or accounting related fields? I would just put whatever the internship is. It doesn't matter. It's not relevant right now.
Yeah, yeah.
Yeah.
So I took put like whatever internship
Yeah,
is.
just put down the internship
Yeah,
time.
and
It's not
then
relevant.
next section they have like this employment information. So if I put like 4 months over there, so should I put anything here or to leave
Current
it?
employer. Just put
Yeah,
the
this
current.
one is current, but I'm not working now, so to,
Then don't put anything down there. They don't need to know that. Do you know where you're going to be working? I thought you
yeah,
got an offer from somebody.
yeah, I got an offer, and then they said like fall, next fall, so around
I
like
would go ahead and just put them. Well,
maybe it's not
don't put it
relevant now.
now.
Yeah,
Now it
it's not.
doesn't. It doesn't
Yeah,
need to be done now.
it's not relevant now. So
Yeah,
I
I'm
took
sorry.
leave it.
I want to. I want to. I want to stop